Let's start right in the middle of a total disaster. An employee has just torched a fortune on a bond position that went completely sideways. He's broken, stammering, and finally just blurts out the only thing he can think to say.
Just imagine that for a second. The pressure, the sheer weight of that loss, the feeling of absolute crushing failure. Now, in any other office on Wall Street, this is when HR gets called, right? A quiet word, some support, but this wasn't any other office.
That was Michael Steinhardt's response. Not yelling, not empathy, just a flat, ice-cold question. And right there in that one single exchange, you get the entire story. You see the psychological brutality that fueled one of the most incredible money-making machines in history.
So how in the world do you square that kind of interaction with this number? For 28 straight years, Steinhardt Partners cranked out a 24.5% compounded annual return after fees. This didn't just beat the market, it basically tripled the S&P 500. And this wasn't luck. This was the direct output of a system built on agony, not on comfort.
You see, Steinhardt's edge wasn't just in picking stocks. It was in the very air his people breathed. He intentionally engineered an environment of maximum discomfort because he truly believed that extreme pressure was what created excellence. For him, comfort was the absolute enemy of returns. And he made zero apologies for it. His goal was brutally simple: achieve the best possible absolute return, period. It didn't matter if the market was up, down, or sideways. He wasn't being paid to be a mentor or a friend. He was paid to win. And his entire firm was just an instrument fine-tuned for that one single purpose.
Look, these aren't my words. These are the actual terms his own employees used to describe the place to a psychiatrist. Battered children, random violence. Analysts would literally shake or cry or get physically sick after his tirades. This wasn't a workplace. It was a psychological combat zone.
He was so convinced his method was essential that he even brought in a psychiatrist for organizational therapy. But the second that therapist tried to step in and de-escalate one of Steinhardt's screaming fits, he was basically told to get out and never come back. The system, as brutal as it was not to be messed with. Okay, so how did this insane culture of pressure actually create an intellectual edge? Well, it was all built to serve one core idea, a concept Steinhardt famously called variant perception. Now, this is really important. This wasn't just being a contrarian for the sake of it. It wasn't about buying stuff just because no one else liked it. It was a disciplined, relentless hunt for a truth that the rest of the market had completely missed. It was about knowing something others didn't and understanding the consensus view so perfectly that you could see the exact moment it was about to break. And to make sure nobody got lazy, he forced every single idea into this brutal 2-minute pitch. You had to lay out the consensus view, explain exactly why it was wrong, and, this is the key part, identify the specific trigger that would prove you right. There was zero room for maybe. As he used to snap at people, you can't invest real money based on maybe. This was the question, the one that hung over every meeting, every decision. It was the absolute price of admission if you wanted to get the firm's capital behind your idea. You couldn't just have an opinion. You had to have an actual, provable edge. And when he had that conviction, he acted with a speed and aggression that's just mind-blowing. Check this out. In a single month, he completely flipped his fund from being 55% net short, that's a huge bet on the market crashing, to 35% net long. This guy had zero emotional attachment to his positions. He was only attached to being right. It's like he was just wired differently. Most investors are terrified of shorting stocks, where your potential loss is literally infinite. Steinhardt? He loved it. He actually got more satisfaction out of betting against the crowd, a strategy that is famously dangerous and just psychologically grueling. For nearly 30 years, this mix of psychological warfare and intellectual aggression just worked. But the very things that made him so successful, that aggression, that conviction, the willingness to use leverage, they were the very same things that would eventually drive him right to his breaking point. 1994. That was the year it all came apart. The machine didn't just slow down, it completely shattered. It was this perfect storm of catastrophic financial losses on a massive leveraged bet that went wrong right at the same time he was under siege from the US government. So, what was the mistake? Simple. He stepped way outside his circle of competence. He got so confident in his ability to win in US stocks that he thought he could do it anywhere, and he made this gigantic, leveraged bet on European bonds, a market he just didn't know inside and out. And when the Fed suddenly jacked up interest rates, the bond market got massacred, and Steinhardt was caught completely flat-footed.
And the result was a catastrophe. In just 1 year, his fund lost almost a third of its value. For a guy whose entire identity was built on winning, on producing absolute returns, this wasn't just a financial hit. This was a deep, personal failure.
And if that wasn't enough, at the exact same time, a long-running SEC investigation finally came to a head. The government claimed his firm had worked with others to illegally corner the 2-year Treasury note market. Now, he always denied he did anything wrong, but the pressure was just immense. The firm ended up settling for $70 million, and Steinhardt had to personally pay 75% of that fine.
This was his official statement, but read between the lines. Whether he was guilty or not doesn't really matter. What matters is the toll it took. The sheer weight of fighting the government while his fund was bleeding money, it was just all too much.
And that all leads to the final act. To his credit, Steinhardt spent the next year clawing back almost everything he'd lost. He proved he could still do it. But the game itself had changed for him. The price he had to pay for his edge, it had just become too damn high.
You know, he'd survived market crashes before, like the big one in '87. But this was different. 1994 wasn't just some market event. It was a psychological wound. It wasn't just about losing capital. It was about losing that aura of invincibility.
And this might be the most honest thing ever said about what it takes to play at that level. The psychological scar tissue was permanent. The thrill of winning just wasn't worth the soul-crushing agony of losing anymore. The fire was going out.
So he quit. But he didn't sell the firm. He couldn't stand the thought of his name being on a business that he wasn't personally controlling every single day. So he just shut it down. He gave all the money back to his investors and just walked away. It was an act of pure survival, driven by total exhaustion.
Which leaves us with this one central, really uncomfortable question. Steinhardt's methods, they produced absolutely legendary results. He rewrote the rules. So you have to ask yourself, was this genius? Was it unsustainable? And in the end, was the price of that edge really worth paying?